All right, guys, big news. I got me a cold one right here to sip on while we're talking about this. It's an exciting day. I don't have a fund manager on, but as far as new funds coming out, they finally came out with the lightning spread, and I couldn't be any happier. I cannot be any happier. Now, you guys know I talk about the lightning spread all the time. If you guys don't know what it is, we'll get to that part. All right, so let's share the screen here and go to the email I received this morning. Catch the rest of the world up on what's going on. It's from Defiance, and it's QLDY is the ticker, and it's their lightning spread product. And once again, we'll get to the lightning spread part of it here in a second. So here it is. I'm trying to zoom in so you guys can see that. I'll move this up here. Okay, QLDY, Defiance ETFs, launches QLDY, the first ETF to pay distributions twice weekly. I know a lot of you guys will be happy about that. That's not so much what this video is about. We're going to talk about the strategy they're doing, but I'm glad for the people that want the more frequent pay because it's here. It says Defiance, blah, blah, blah. So it's a NASDAQ 100 lightning spread, the first ETF designed to pay distributions twice a week. Remember when they said it was going to be daily? I said it wasn't. People disagreed with me, but it looks like I was right. At least so far, it's not daily. All right. QLDY seeks to combine a breakthrough income strategy with exposure to NASDAQ. Yes, and their strategy is a breakthrough strategy. That's what I want to talk about. Look, it's even trademarked. It's actively managed, blah, blah, blah. All right, synthetic long exposure. So they purchase a long, deep in the money call option to be their synthetic for stock. Today currently they have a 1,000 strike NDX option. NDX is trading at what, 20,000 or something, 20 more than that. So a 1,000 strike is virtually nothing. I mean, it's all the way in the money. A 99 delta. It'd be 100 delta if it could be, but it's 99.999 delta. I mean, it's basically stock. Anyway, that's their long today. I've already checked it out. For their daily income generation, they're doing the lightning spread. We'll talk about that in a second, what that actually is. Enhanced yield support was that. Oh, and then they have, because it frees up money because they're using options, so they have money they can keep in treasuries. Okay. Yeah, I can't believe it's going to do twice a week, and I don't know which days it is. It doesn't matter to me. I mean, I'm sure the people that it matters to already know about that. So that's not what I'm here to talk about. I did a back test on it, and it looks pretty promising. I did a back test or two. Let's go over here to just really quick to option strat, and we'll show what a lightning spread is really, really fast. I'll try to do this fast. So if we're going to do one today, it's too late to do one for today. So we would do one for tomorrow. 1 day lightning spreads. They're zero DTs. I don't know if they do them in the morning or the night before, but just for demonstration purposes, it would expire tomorrow afternoon, not tomorrow morning. That'd be weird. Okay, and a lightning spread is just a bull put spread. So you sell a put and then you buy a put that's further down. And let's see here. I'm trying to think I looked to see what strikes they're using, but they don't have any. All they're showing is there's 3 legs of a lightning spread. There's the long leg, and then there's the spread. Well, they don't have the spread in there. So I'm just guessing. On a daily basis, let's see, I think they're going to sell like the 40 and buy like the 35 or something. I think it'll be pretty thin, something like that. All right. So they'll do something like that. They'll sell one for $64 and they'll buy one for $51. They'll make the $14 or it's a, $1,350 credit. They'll do something like that. That's all a lightning spread is. So a lightning spread is just a bull put spread. So, I mean, that, and that looks also just like a caller. You could do this with stock, a call, and a put, this same exact trade. It's just a caller. It's the alti trade, but you don't even have to do that. You can also do it with 2 puts, and you don't even need stock. Here's the catch that they do it. Even though you don't need stock and you have a caller, this is a perfectly legitimate trade. This is what Alti has on all their positions right now, this trade, but they don't have it with 2 puts. They have it put on with long stock, short call, long put. So they have on a 3-leg version of the same exact trade, right? Well, these guys, and I told this to Nicholas from David from X Funds. I said, it's almost like you guys are cheating because they're sneaking in an extra long because they have this, then they have plus stock. You could do this if you had stock, but now the NDX doesn't have stock. It's an index, and it gets that favorable treatment, and it's what they're using. So, so they, instead of stock, you can use a deep in the money. So you can just hit buy call. Okay. And we have to hit change expiration on this, because their expiration, they go out. And so we'll just do that plus buy the Qs. Okay. That's a better, the reason it's called a lightning spread, there's a little zig in the zag, and it's because between 597 and 592, you're long and have the financial exposure to the stock. Plus you're also long through the put spread. You have essentially a collar on there, but you're synthetically long. So you're double long between those 2 points. And it gives it makes it look a little jagged sometimes. They've got the system hacked. It's the same thing as owning the stock. Downside's basically the same. There's a little bit of a penalty if it goes through these strikes. The penalty is the width of the strikes. So 6 points less the premium they received, which is about $1.50. So it's a $4.50. It's a $4.50 double down is what this bet is. So if the market goes down, you're on the hook for the market going down through your shares or your synthetic or whatever. You're on the hook for that, just like and that's fine, or that. But then you also pay an extra $4.50 toll for the lightning spread. And it depends on how far out of the money they go and how far apart they put their legs. But that's all a lightning spread is. So what a lightning spread gives you, though, it gives you a situation where in an increasing market, you have the upside you would otherwise have. You don't have any calls. You don't have any call spread even, where you have to wait for it to get out of the flat spot to start making money. You just do like you would otherwise do. And because you are on this side of the expired options, the expired put options, you realize that gain. So you get stock plus $450 or plus $150, plus whatever the premium was. Yeah, $150. So what's not to like about that? And you can do that every day. You can make that $150 every day. Now, whether you can earn it or not, I mean, that's another story, but you can make that every day. And as long as the market keeps going up, you're doing great. If the market goes down, you lose what the market would lose plus an extra 150. If the market goes, plus the inverse, plus 450. Let's assume it goes through the strikes. I mean, in a bad market, you're going to lose 450, but in a good market, you're going to make whatever the market is, not only uncapped, plus a bonus 150, plus so you could, in other words, or you could pay yourself that yield and not feel bad about it. There's no upside cap involved. Okay. So now, sorry if that was kind of, but let's see if this is a better way to look at it. So I put this strategy. Let's go back a year and let's just kind of break it down. Now, the first thing I was saying, the lightning spread itself is you sell a put, and right here we have sell put. We have it, and we're doing it every day. So the 1 DTE, they don't have 0 DT on this. You'd sell it the night before, and it's one DTE. And these expire to cash. You would just let them expire to cash. And this is with SPX, but anyway, so the 40 delta means 60% of the time the market's not even gonna go past it, and it's gonna be just a good news situation. So it's a little bit, so it's a strike or two out of the money, and then go in and buying the 30 delta. All right, so we could do that by itself just for the last year. And that's the income component. And we have to do that first to see what kind of income that would have brought in. But let's just do it. Let's go back a year and do a lightning spread like I suspect they're going to do it. And we'll see how it would have done. And I can be way off with the strikes and stuff. And I wish they showed it. I could show you guys the prospectus if you wanted to, but it's boring. It's boilerplate. Maybe we'll take a look at it here in a second. And I downloaded the positions, and I wanted to show them, and I still can show them. They're right here. Here's the positions. They have this right here. See this 1,000 strike call? That's their deep in the money flex option. It's a flex option when it has a weird strike. It doesn't end in 0-0. And they have one of those right now. But these are gigantic contracts. I mean, what's the at the money strike on these? I always forget. But by tomorrow, they should also have two other options dated, short dated options. And once we can see those, we'll know for sure. But here's what I suspect they're doing. Let's go back to the backtester, something like that. Maybe selling the 40, buying the 30. And they probably vary what they're doing, but I'm saying if we had to put an average thing on it to run a back test, I'm sure they use judgment, and sometimes they move it closer and move it further away and all kinds of stuff. So, but let's just kind of do a generic lightning spread. How about that? All right. So a generic lightning spread, let's look over the past year. Would have won 63% of the time. The one we were testing, the 40-30, and it's $415 a day average premium to put it on, and that's $130,000 over the course of a year. So that of income that an ETF could pay out, $130,000, but you can't. If you did just this strategy, you don't have the total return to justify. Your total return's basically flat. You're down 1,400. So you can't justify paying the income out. But the lightning spread is a teammate strategy. This is the income sleeve. And then it's going to pair this with the teammate. It's like the wingman strategy at a bar. And then here comes or whatever. It's like, it's an old story here. And then here comes here's the one you really want to do well. This other one's kind of a sacrifice, where it's a tool to generate yield that you can distribute, but you need this one to make the fund work. So this is your long, and in covered calls, yeah, let's face it, the long that's in a bullish market. That's what keeps the strategy afloat. That's your primary bet. The other bet's kind of a side bet. So anyway, so here we have this. So we're going to buy one, and I don't know what tenor they're using yet. I'll just use 30-day, or we did see the tenor on that. Hang on, let's go back and look at that. The tenor on that was, I think it was way out there, 12.19, so 90 days. Okay, well, we can adjust to that. That's no problem. Past 12 months. Yeah, so here's the lightning spread at its best. The past 12 months, it would have outperformed buy and hold by quite a bit. Now, it had about twice the max drawdown, but it outperformed buy and hold. It had a better risk-adjusted reward. That's the whole idea of the lightning spread. I think that's what they're trying to do. So let's go back and look at that one more time. Just the income component. just the income component over the past year, about broke even overall, but it did generate $50,000 worth of premium. So they would pay that out as return of capital, an ETF would. So $50,000. So then we need to add in the 99 delta, and we'll just use a little bit closer expiration. And how far out the expiration is doesn't really matter as much as other stuff. You could use these other ones too. Okay, and it looks like you'd be well off to use this one, because over the past year, using the 99 delta 7 days till expiration call, you would be killing it. You'd be outperforming buy and hold by a bunch. And remember, see this over here, total profit $111,000. That includes that, or actually it doesn't, but remember the option selling scheme grossed $50,000. Okay, you could pay that $50,000 out by the end of the year and still have NAV that goes up, because the total fund made $111,000. The reason the fund's doing so well, one reason is because it's a bullish market and they have this deep in the money option that goes up when the market goes up. So yeah, I'm needless to say, I'm really excited about this strategy. So if they could do something like this, then they could have in theory, they could have a fund that actually paid a yield that was distributable, and it might have a chance of outperforming the market. No guarantees, but like in this case, it outperformed buy and hold. The strategy worked. Now this is over a short time frame, but no guarantees. But that it would be cool. I think this strategy at least has a scheme to be able to have a chance at outperforming buy and hold, which is awesome. The other ones, that's one thing you give up when you do covered calls, which is fine. You give up, you say, okay, I know I'm not going to perform as well as the underlying. Well, wonder if they've invented something. And based on these back tests, I was up late doing back tests on this anyway. I didn't know QLDY was going to come out, but I have my own version of a lightning spread, an even better way to do it, that even back tests better. But anyway, so I was up late working on that, but then their way is fine too. Their way back test just fine too. I was using something else instead of the 99 delta. I was using something else, but anyway, it's fine. So look at this. Over the past 5 years, these are lightning spreads. And there's no customization. There's no stop losses on these. These are index options. And so you put them on and just let them expire to cash. Because they expire to cash, you don't have to do anything. There's no chance of getting assigned or exercised. But they're also the better tax treatment. So that there's a lot of ETFs that like to use these. So I believe this is pretty realistic, because they're just putting the spread on the day before and letting it expire. It makes a yield, the lightning spread part with the put spread. It makes a yield every day that they can distribute. So here's this over the past 5 years. The thing's up 284,000, where the market's just up 168. The drawdown's the same. It's the same drawdown as the market. Looks like it has about twice the risk adjusted reward. And this is without any curve fitting. You could make it do all kinds of stuff with, stop losses and profit targets, and only do it on Wednesdays or all kinds of stuff. This is just doing it once a day. And it looks like it makes about 50,000 a year income. And over 5 years, the NAV was up 250,000. So it looks like it could have paid out the $50,000 yield and the NAV would have been flat. This may be the mythical fund. I'm hoping it is. I'm really hoping it is. We'll start following its trades. How about that? But hopefully this is a pretty good a pretty good explanation to start off with. The only variation I was doing is you could do this, do the lightning spread. Sure. Great. Yeah. Do the lightning spread, but, get you a little leverage by getting 3 out of the monies, get 325s in the 7-day time frame. And anyway, if the market goes up, you'll be fine. This won't do as well in a neutral market. Their way is probably better, but I was doing this. This is one of the best back tests I've seen. You could do this trade every day. We'll call it the max convexity spread, but it's the same. It's in the spirit. It's in the same spirit as theirs. You have some type of synthetic long. Mine just happens to be 3 out of the monies. Theirs is 1 deep in the money. It's whatever. I mean, that's why they're professionals. But let's see how mine tests out. Anyway, are you guys going to get QLDY? I mean, for people that want to get paid all the time, twice a week's better than once a week. I mean, I could see it, but I almost think they should have just gone to daily, but I'm not for that though. I hope maybe twice a week we'll get people pacified. Okay, so you can see, well, that's one problem. My strategy is it has when I do it with those out of the monies, it has a higher max drawdown than the other strategy. And that's why the ETF does it the way they do it. Their strategy, they had about market risk. The max drawdown, remember, over the past 5 years, when I ran it with the 99, you could use those far out of the monies, but you increase your drawdowns. But that's also because it takes less money to run the strategy. You could also start it with more money and kind of offset some of that. But in any event, it's whatever. But yeah, that's not the worst looking. It's not the worst looking strategy. All right. So that's, yeah, it's funny. I happened to be working on that all night. And then I saw this QLDY came out. All right. So let's go to the tape. Let's tell it the tape. Let's go see how it's trading. It's trading at $50. Let's put it on a little 5-minute chart. Heck yeah, it's up. Bye, 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 bye. Looks like its first tick was, I can't tell. It's hard to say. 850. It looks like maybe it didn't trade till 850. Its first tick was right here, 50.49. Then it traded down to 50.40. But anyway, now it's up here at 50.60 or 50.70. Heck yeah. So this thing, so here's the thing about this. So right now we have triple QY. I'm not knocking QLDY, but I'm saying let's get some daily charts on. Let's look at some competitors. So let's see, right? We have a plethora of Q funds. And so look at triple QI. Look how well this thing's been doing lately. It's at a high. Is that an all-time high? Yeah, probably an all-time high. Yeah. Including the dividends, if you're dripping it. I mean, but we have triple QI, and they pay a target 30 income. But then we have triple QT, both excellent funds, and they pay a target 20. And then we have, from Yield Max, but also a similar, a daily type strategy. What did they do? They do daily synthetic covered calls. So, but I mean, it's similar. It's a similar risk and reward. And then we have QLDY, but the big but here, have you seen this? And then we're coming out with these leverage plus income. I'm making a video on it now, and they're going to have one called QQY, which is leveraged plus income. So we have a lot of choices out there, folks. Lots of choices. What are you guys going to do? I just wanted to get out here in front of that and show a little explanation on the on the strategy and on the back test and stuff. This could be a monster. The back test, the back tester is not where money's made. We have to, but we'll follow it in the real market. And after a couple of months or whatever, because I'm also going to follow it in the back tester, we'll see how close it is. But I really think this is the first strategy that has the best chance of outperformance, that I've seen in a while. But with the caveat, same thing with Roundhill's latest ones and Rex. Those Rex ones have a big chance, but these also have a huge chance at outperformance. So we'll see. And we'll get down the road a quarter and we'll see if they have outperformed. But I mean, these are definitely interesting, and we'll keep an eye on them. All right, guys, let me know in the comments. Have a good day. Talk to you later.